You possess a bank account. Right now, three policy updates are taking effect that determine how much of your own funds you actually get to retain. Curious financial institutions are not mailing notifications regarding any of this. Here's what that costs an individual who remains unaware. A single scheduling conflict between a Social Security payment and an automated billing charge can drain $70 or more before the month even begins, not due to overspending, but from failing to recognize which questions to ask. By the end of this video, you will have three specific inquiries to present to your bank this week, alongside one document to review today. Furthermore, the third policy is the exact detail almost nobody opening a deposit account ever thinks to inquire about. Surprised? It sits in your account agreement right now, and it might signify hundreds of thousands more in financial safety than you assume you possess. Every week on this channel, I examine the actual regulatory shifts financial institutions implement, not the promotional wording in their advertising materials, but the terms in the fine print. There is nothing to purchase here except practical details nobody provides for free. If that provides value, consider subscribing and enabling alerts because these terms continuously shift and most institutions rely on you not paying attention. Now let us examine the details. First update, the overdraft penalty restructuring. Here's where most consumers misunderstand the situation. They assume overdraft charges represent an unavoidable expense of maintaining a bank account. For decades, these penalties formed a significant portion of institutional earnings. Older adults living on fixed incomes face the heaviest impact because a Social Security transfer arriving a day late or a Medicare deduction processing a day early proved sufficient to trigger a $35 penalty that had zero connection to actual overspending, the traditional practice of default acceptance. Accepting whatever your bank assesses and assuming every competitor assesses identical fees is the incorrect strategy. Currently, regulatory bodies and several major financial entities have moved toward limiting those charges or substituting them with reduced flat rates, while some currently provide a brief grace window, occasionally a complete business day prior to a penalty applying. Certain institutions have gone further, introducing small optional balance buffers that absorb a deficit without traditional penalty charges attached whatsoever. Here's the catch, and I intend to be entirely upfront with you regarding it. This policy is not uniform. Particular institutions adopted lower limits voluntarily. Others continue assessing legacy rates. Smaller local institutions and credit unions frequently operate outside these same pressures entirely. Furthermore, some still assess an independent charge for every single item that processes, while your balance remains negative, rather than a single daily cap. Therefore, do not rely on my description of your bank's practices. Contact them directly to verify. Ask three precise questions. What is the current overdraft fee? Does a grace window apply? Can you decline overdraft protection entirely so transactions simply get rejected, rather than approved with an added penalty? Consider how this scenario unfolds in practice. A recurring medication transaction processes on the 3rd. The Social Security transfer typically arrives the same day, but this month, it posts several hours later due to a calendar shift. The pharmacy debit processes first. The balance dips negative for a few hours. By the time the deposit processes, a fee has already been assessed. Multiply that scenario across both a checking and savings account at an institution that assesses independent fees for every overdrawn item, rather than one daily flat charge. That single timing mismatch transforms into $70 or more lost before the month truly commences. 3 inquiries stand between you and that $70 loss. Keep watching. Second update, the policy that carries the greatest impact. If you have ever utilized Zelle or an instant transfer system, this concerns who absorbs the financial loss when an individual deceives you into transferring your own funds. For years, a significant ambiguity existed here. A fraudster poses as a family member, sends a fake security alert, or conducts a fraudulent technical assistance call. Because you technically authorized the transaction yourself, numerous institutions maintained it fell outside traditional fraud coverage, which clearly applied only when an unauthorized party accessed your account directly without consent. Here is why that regulatory gap is closing. These calls operate entirely around artificial urgency. The caller already possesses the final 4 digits of your account, sounds authoritative, and asserts that a criminal is draining your balance at this moment. Consequently, you must transfer your funds to a secure destination immediately. Every element of that call is crafted to compel you to authorize the transfer yourself during a moment of panic within minutes. Under previous standards, the moment you confirmed or communicated a verification code, the transaction counted as authorized. Authorized meant the financial institution owed zero reimbursement. That reality has shifted. Regulators have been instructing institutions and transaction networks to handle specific scam-driven transfers, similarly to unauthorized fraud, particularly when patterns align with recognized deceptive schemes. Certain institutions are currently reimbursing claims they would have flatly rejected several years ago. I will not exaggerate this shift. Implementation remains varied across institutions, and resolution is not automatic, but the discussion differs significantly from previous years. Should this occur to you or a family member, report the incident to your bank immediately. Inquire explicitly whether it qualifies under their updated scam resolution guidelines, and request that answer in writing rather than verbally over the phone. Preserve the originating telephone number, the exact timestamp of the transfer, and any text messages or caller identification records. That documentation frequently represents the precise boundary between an approved claim and a denied one. Third update: accounts that remain inactive. Every state enforces escheatment legislation, the administrative procedure where an institution surrenders dormant funds to state custody after a designated timeframe without activity, typically 3 to 5 years depending on your jurisdiction. Multiple states have tightened the definition of activity, while others have shortened the timeline before your account gets flagged and transferred to the state's unclaimed property division. Here is why that matters, even if you maintain careful records. This does not involve accounts you simply forgot exist. It involves secondary accounts you rarely access or a relative's account managed from a distance. Once funds transfer to state custody, recovering them requires submitting formal claims, providing proof of identity, and occasionally waiting several months. The solution costs nothing and requires 5 minutes. Access every account you maintain at least once every quarter, including those you rarely utilize, as most institutions classify a digital login as active engagement. Additionally, review the designated beneficiary or payable on death documentation on every account, because that single form determines whether your assets transfer directly to your chosen individual the moment an unexpected event occurs or remain stalled in legal probate for months. Here's what I advise you to review next. The secondary benefits, savings programs, and assistance options many older adults qualify for but never actually utilize have been organized into a unified resource arranged by state and category, eliminating the need to search through complicated official portals for hours. It operates efficiently, remains straightforward, and allows any senior to identify precisely what matches their current circumstances. Regardless of your location, valuable support exists that you might currently be overlooking. It is titled the Senior Exemption Guidebook, located directly within the primary pinned comment beneath this video. Selecting it once provides access to all necessary details. Now remain here because the final point is where a simple checking balance quietly expands into a substantially larger figure, representing a layer of protection almost nobody opening an account considers asking about. Before addressing that, here is one detail connecting the first and second updates. An increasing number of states have established what is recognized as a senior safe framework. This grants financial staff legal authority, and in specific jurisdictions, a mandate, to delay a transaction and submit a notification if they suspect an older customer faces financial exploitation. That legal protection did not exist across most regions a decade ago. A representative who identified suspicious activity previously possessed almost no formal protection for intervening. Currently, within states enforcing these measures, that same representative can pause a large or unusual withdrawal, request additional details, and flag the account without incurring liability for delaying the process. Certain institutions combine this with specialized employee training designed to identify indicators of external pressure, such as a customer frequently checking a mobile device or reading statements from a script while speaking with staff. Therefore, if an institution has previously questioned you before approving a substantial withdrawal, that represents the underlying reason. The institution is not creating unnecessary obstacles. Rather, a protective mechanism is operating precisely as intended. It remains worthwhile to ask directly, has your state enacted this framework, and does your local branch maintain a formal protocol for it? Now, for the critical element most account holders overlook completely: FDIC coverage limits. Most individuals assume $250,000 represents an absolute maximum ceiling on how much money receives protection at a single institution. Here is where the general understanding breaks down. It does not. Ownership structure represents the primary detail that rarely gets explained clearly. An individual account held exclusively in your name receives coverage up to $250,000. A joint account held with a spouse receives separate coverage of $250,000 per person, creating $500,000 total protection on that single joint vehicle. A payable on death account featuring designated beneficiaries can qualify for separate coverage, calculated based on the total number of eligible beneficiaries named on file. Specific trust structures similarly receive independent category treatment determined by the count of named beneficiaries. Calculating these options together, a retired couple maintaining an individual account each, one joint account, and a payable on death account listing 2 adult children could maintain over $1 million in fully protected balances at a single financial institution. This outcome relies on zero complex financial products, stemming entirely from how account titles are structured. Conversely, the opposite scenario occurs frequently, which should prompt you to contact your institution immediately. If you have consolidated various accounts at one institution over time without reviewing ownership structures, you might maintain balances exceeding protected limits right now without realizing it. The adjustment costs nothing. Contact your financial institution, request a review of how your accounts are classified relative to FDIC ownership categories, and update beneficiary designations if any funds remain exposed. Do not accept an initial summary without verification. Request that they walk through every account category alongside you explicitly, line by line, until the confirmed coverage figure matches actual protected limits. Revisit this alignment whenever a major life transition affects your household, rather than reviewing it once and assuming it remains current. Should a spouse pass away, a joint account converts to individual ownership, which can instantly reduce coverage limits at the exact moment a surviving partner requires financial security most. Should a beneficiary relocate, update their legal name, or no longer represent your intended choice, the official document resting in an institutional file will not update automatically. Financial entities do not issue reminders regarding these details. The paperwork sits quietly until the moment it becomes necessary, which frequently represents the worst possible time to discover the information was outdated. Here is your actionable checklist for this year. Contact your bank. Inquire about the current overdraft charge and whether a grace window applies. Inquire whether their scam resolution guidelines extend beyond traditional unauthorized transaction fraud and obtain that confirmation in writing. Access every account online at least once every quarter, so no balances transition toward dormant status. Review the payable on death designation on every account you hold. Inquire whether your state enforces senior safe legislation, and request that your institution review your account titling against FDIC ownership categories so you know the actual protected figure rather than an assumed amount. None of these actions require transferring institutions, enrolling in new services, or paying any fees whatsoever. These options exist within your current banking framework.
The primary reason many older adults never utilize these protections is that institutional staff are not obligated to explain them unprompted. Once you understand the correct questions, the entire discussion requires roughly 10 minutes. 10 minutes can determine whether funds quietly vanish or remain securely where they belong, with you. Share in the comments which of these 3 updates you plan to review first, as I read every submission. Next week, I will address a Medicare oversight that costs the average retiree over $1,000 annually, which almost nobody notices until the statement arrives. I am not a licensed financial advisor,